markets do sometimes turn on a dime, and you don't necessarily know where things are going to be, 3, 6, 12 months from now.
Hello, my name is Chris Mellone. I'm partner and financial planner here at VLP.
Hello, I am Sean Beznicki, Director of Investments here at VLP.
Cool. Well, Sean, we are over the halfway mark for the year. There's obviously been a lot going on in markets, to say the least. We thought it would be a good idea for us to get together, talk about where we are, what's driving the market, unpack some of our thoughts as we head into the second half of the year.
Yeah, sounds great. Lots to talk about.
So let's go ahead and we'll go asset class by asset class and talk about some of the main drivers. Let's start with bonds. There's been a lot of chatter about interest rates, where they're going to go for the back half of the year. Obviously, a lot of pressure on the Fed to cut rates at some point here in 2025. What are your thoughts on that space in general?
We could pontificate rate cuts all day, but the fact of the matter is that fixed income is doing exactly what it ought to be doing. It is providing income to investors at a pretty good clip. And recall that starting yields always tend to be indicative of forward returns. Therefore, you're going to get likely a 5.5% on your fixed income, and we're talking just your traditional treasuries investment grade. If you wanted to go further into that risk spectrum and go high yield, you're going to get a whole lot more. You're talking about coupons that are north of 7 or 8%. Spreads are a little tighter than historical, but the credit market doesn't seem to be too concerned with things right now.
Right. And it's interesting because the credit markets are always, hey, am I going to get my money back? So they're really the first market to start pricing in weakness in the economy. And like you said, they're not pricing that in yet. I know across our portfolios, most bond positions are up between 4 and 6%. Halfway through the year, that's a great place to be. I also think it's important for us to talk about where our 10-year yields are as a country relative to the rest of the world. I think that's going to really play a big hand in where rates go from here.
Absolutely. You look at, our interest rates versus other developed markets, and we by far have the higher rates, and therefore we are going to get, more of those foreign flows. And as long as our economy, seems to be steadily improving, or if there is some growth, that again is going to bring that confidence back in, bring that cash flow back into our treasuries, and more of our fixed income assets. It would be wonderful if we did get a rate cut and we saw maybe a counter trend rally in the dollar, and the dollar is something we can talk about in a little bit. But once that cut happens, then that could be that confidence returning back into the U.S. And therefore, again, we're going to see more of those cash flows. Currently, right now, I think that there is a lot of uncertainty surrounding the U.S., both from an economic perspective, from a growth perspective, trade, and that has put pressure on the dollar just a bit, and that's why we've seen those declines that we've seen this year.
Yeah, for sure. And you look at our 10-year treasury, it's at roughly 4.4%. So, we're there. And then you look at the UK, they're almost a full percent lower than us. Most of the rest of Europe has lower rates, and obviously Japan's yielding like 150 basis points. So, if you're an allocator and you're saying, yeah, I have this conservative pool of assets that I need to put to work, the U.S. still, looks relatively attractive relative to the rest of the world.
Absolutely. I mean, there's a tremendous amount of arbitrage opportunity where you can, borrow from one, invest in another, and make that spread. Of course, you have to be concerned about any sort of unwinding of those positions, like we saw. I believe it was last year with Japan, and the U.S. dollar, that carry trade unwinding. So there are risks in doing that, but yeah, for the writ large, we do still seem to have the best offerings.
Cool. So overall, yields are at really reasonable levels. A good setup heading into the second half of the year. Let's move over to the equity side of the ledger. Let's start with large caps, and specifically just themes that you've seen in the large cap growth segment of that market.
Yeah, to start the year, we would have thought that maybe the AI trade was a bust, tech was overbought, and the U.S. exceptionalism was dead. Fast forward to where we are today, the S&P has rebounded from its April lows. Large cap companies have proven themselves to be a bit more resilient than we would have expected. The dollar still is putting pressure again on the U.S. versus international returns, but there is still a lot of promise in these large cap tech companies, specifically those that are the hyperscalers, for what is going to likely be a continued growth in that sort of AI space.
Yeah, and the way that I've explained that to clients during our meetings is say 2023 and 2024 AI was this sort of new shiny thing. The stocks benefited from that. Then there was that 5 to 6 month period where there were a lot of question marks. Hey, is it going to benefit productivity? What's it going to be used for? How's it going to drop to the bottom line? And now that momentum is clearly back in a lot of those names. Let's talk about the large cap value segment of the market. That is an area where we really feel it's important to own a lot of good businesses that have high dividend paying balance sheets, and it really complements the large cap growth segment well.
Absolutely, it's a tremendous compliment, especially because large cap growth is so concentrated on growing their own earnings. They're not paying back the investors the same way that large cap value companies are, and we really need to consider the fact that dividend returns are an important component of your total return as an investor. And this is more important now than ever because companies are increasing dividends. They are trying to make keep those promises to their investors, especially as cash is still yielding, somewhere north of 4%. You want to make sure that you're offering something as attractive to get investors into the funds, into the companies, because they aren't going to have those necessarily same pops that the large cap growth companies are going to have.
Right. In this segment, this is where financials, lie. And if we look at one of the themes that we've seen, especially over the last handful of months here, is the initial public offering window. So companies that are private and then eventually go public, that is beginning to open. And there's a lot of companies that are in the AI space that are expected to go public over the next 12 to 24 months. And financials have really as much momentum as they've had since the financial crisis. So that's an area where we say, hey, there are a lot of businesses there that have a lot of tailwinds for the back half of the year. If we think about size companies, large caps in general, I know that we talked about the AI theme specifically and benefiting the large cap growth segment of that market, specifically from an investment perspective. But I think it's important to realize that larger companies, just because of the nature that they have more employees, more roles, things like that, they're going to benefit the most from AI in general. So I think that their margins are ripe to really expand as more AI is later into to different businesses, more so than mid or small caps. So that's a theme that we'll see play out over the next couple of years. Let's shift gears and talk about small caps. There's a lot of different dynamics at play there. What are your thoughts on small caps in general?
Small caps is a really interesting space because they have the propensity to do really well, but also are so tied to sort of the economy of the U.S. They're just super sensitive to rates. You can have great years like 2023 and 2024 where you get almost double-digit returns, and then a year like this year to date, where small caps have been down. The dynamic and the belief is that once rates do go down, and because small cap companies, which tend to be levered, will have lower interest rates to contend with, that will actually be a huge tailwind. So this is definitely an asset class in waiting. It just needs a little bit of that catalyst, I think, and to bring back a lot of that consumer confidence, a lot of that investor confidence into the space. Speaking of financials, there are also a lot of financials embedded within the small cap universe. They too will likely see a tailwind as we see rates start to decline. Rates aren't hopefully going up from here, so we're hopefully looking a year out and seeing some of that benefit.
And small caps, obviously, as you'd expect, they can move very, very quickly. So in a handful of rates, or a handful of weeks, I should say, those stocks move between 5 and 15%. Let's talk about international markets. There's a lot at play there with the dollar, our relations with other countries. What are your current thoughts on international?
We've always been believers of having non-U.S. exposure for a myriad of reasons. Obviously, the world itself is still overweight the U.S. markets. You look at the global market cap, 60-some% is still to the U.S., and that's wonderful when things are all humming along. Then you get a moment like you did in the beginning of the year and in April, where you start to see that shift. And this is something that we've always kind of been banking on because we understand the importance of having those diversified geographic exposures, understanding that there are other developed markets out there that can perform as well as the U.S. It just may take, a certain time period. As we saw, the U.S. has been basically in control over the last, 10 or so years. So there was a structural shift that was always on, always looming, and this seems to be the opportunity now. It certainly helps that the dollar, again, as we discussed earlier, has declined year to date, and that has, almost doubled most of the returns for countries in U.S. dollar terms. You look at something like, Japan, the UK, France, even, they've all done exceptional year to date. Again, piggybacking off of that dollar decline.
Right. And finally, let's talk about commodities, inflation, specifically gold and some of the stores of value. There's been a lot of momentum in that space. The question is, hey, can this continue? And, is it justified?
Yeah, gold is also has had a pretty stellar year. A lot of that is due to the fact that safe haven assets. The U.S. used to be that safe harbor in the storm. That really doesn't seem to be the case as much now. Again, as U.S. exceptionalism has appeared to have waned just a bit, and treasuries are no longer where investors may seek that safety. So gold has always been there, and has had its moments. This happens to be another opportunity where we can highlight the fact that it has that stored value. It's a great inflation hedge. Having that exposure has been really beneficial to, not just the investors who have direct exposure to gold or to gold trusts or to gold miners, but to the funds that also invest in them. So using ourselves as an example, we have some international managers who do invest in gold directly or through the miners. That's a small allocation of their portfolio, but it's one that they've always had. We're talking 11, 15% at most. But it's been really beneficial for their returns.
And that's something where it's important to distinguish specifically gold and all of the headlines and chatter that get to. We have it as an investment that we hold through our manager. It's not something that they're trading in and out. And I think, as the debt and the deficit continue to get bigger and bigger, there's obviously a lot going on in the Middle East. World's a complicated place. It seems like gold has a lot of tailwinds here, and central banks continue to buy gold as a way to hedge against sort of all of these unknowns that we're talking about. So that's been a big reason why our international holdings have done so well. So we ran the full gambit there. Is there anything else that you'd like to share before we wrap up?
I just, really, again, having gone through all these asset classes, really just, want to hone in on the importance of diversifying, because, markets do sometimes turn on a dime, and you don't necessarily know where things are going to be, 3, 6, 12 months from now. We get a pretty good picture, a pretty good understanding of maybe, long term, but especially when there's a lot of noise in the market, being invested across these different asset classes will offer different things. And in the aggregate, you will, hopefully have some pretty strong returns.
Awesome. Well, thank you, Sean. As always, we just ask our listeners, if you have questions, things that you want to get our thoughts on, please reach out to us, and we'll talk to you soon.